Investing is exciting, it's your money potentially making more money. But with earnings come taxes, specifically capital gains taxes. Don't worry. This guide makes understanding capital gains tax simple. This guide is for you, the beginner investor. We will demystify capital gains tax with clear explanations and relatable examples. You'll learn how this tax works and how to potentially reduce your tax liability. Understanding capital gains tax is crucial for making informed investment decisions. It helps you maximize your returns by minimizing your tax obligations. Knowledge is power, especially when it comes to your money. So let's dive in and empower ourselves with the knowledge to navigate the world of capital gains tax effectively. Capital gains tax is a tax on the profit you make when you sell an asset for more than you paid for it. Think of it this way. You buy a stock for $100 and sell it for $150. You've made a $50 profit, and that profit is subject to capital gains tax. This tax applies to various assets including stocks, bonds, real estate, and even collectibles like art or vintage cars. Essentially, if you buy something and later sell it for a higher price, you'll likely owe capital gains tax on the difference. The amount of tax you owe depends on factors like the type of asset, how long you held it, and your income tax bracket. Don't worry, we'll delve into these details later. Remember, capital gains tax is triggered only when you sell an asset and realize a profit. If you hold on to an asset that's increased in value, you won't owe any tax until you sell it. You only pay capital gains tax when you sell an asset for a profit. This is called realizing a capital gain. If you buy stock for $100 and it increases to $150 but you don't sell it, you haven't realized any capital gains, so you don't owe any tax yet. Holding on to an asset without selling it is like having a paper profit. It's not taxed until you actually sell the asset and turn that paper profit into a real one. This is an important concept because it gives you some control over when you realize capital gains and trigger a tax liability. You can strategize your investment sales to minimize your tax burden. Remember, capital gains tax is a tax on realized profits, not unrealized gains. So until you sell, you don't owe any tax on the increased value of your assets. The duration for which you hold an asset before selling it determines whether you'll pay short-term or long-term capital gains tax. This distinction is important because the tax rates differ significantly. Short-term capital gains tax applies to assets held for 1 year or less. These gains are taxed as ordinary income, which can be as high as 37% depending on your tax bracket. Long-term capital gains tax applies to assets held for more than 1 year. These gains are taxed at more favorable rates, typically 0%, 15%, or 20%, again depending on your income. As you can see, holding on to assets for more than a year can result in significant tax savings. This is why long-term investing is often a more tax-efficient strategy. Understanding the difference between short-term and long-term capital gains tax is crucial for making informed investment decisions that align with your financial goals. Calculating your capital gains tax. Calculating your capital gains tax might seem daunting, but it's simpler than you think. Subtract your cost basis from the selling price of your asset to determine your capital gain. Cost basis includes what you paid for the asset plus any commissions or fees. Apply the relevant tax rate based on your holding period and income level. The IRS provides tax brackets to help determine your liability. You only pay capital gains tax on the profit you make. Capital losses and how they offset gains. You can experience capital losses when you sell an asset for less than you paid for it. Use these losses to offset your gains, reducing your overall tax liability. For example, a $10,000 gain offset by a $4,000 loss reduces taxable gains to $6,000. Losses exceeding gains can offset up to $3,000 of ordinary income. Remaining losses can be carried forward to future tax years. Accurate records of investment transactions are crucial. Proper documentation ensures you claim all eligible deductions. Capital losses are valuable for managing tax liability. Leverage them effectively to optimize your investment strategy and save on taxes. Strategies for managing capital gains tax. Managing capital gains tax is an important aspect of successful investing. By implementing some strategic approaches, you can potentially reduce your tax liability and keep more of your hard-earned money. One effective strategy is to hold on to your investments for the long term. As mentioned earlier, long-term capital gains are taxed at lower rates than short-term gains, making this a tax-efficient approach. Another strategy is to consider tax loss harvesting. This involves selling losing investments to offset gains realized from selling winning investments. By strategically realizing losses, you can manage your overall tax liability. Investing in tax-advantaged accounts, such as 401(k)s or IRAs, is another excellent way to manage capital gains tax. These accounts offer tax benefits that can help you grow your wealth more efficiently. Finally, don't underestimate the value of professional guidance. A financial advisor can help you develop a personalized investment strategy that aligns with your financial goals and minimizes your tax burden. Tax-advantaged accounts, your savings allies. Tax-advantaged accounts like 401(k)s and IRAs are powerful tools for building wealth while minimizing your tax liability. These accounts offer unique tax benefits that can significantly impact your long-term savings. With traditional 401(k)s and IRAs, your contributions are tax-deductible, meaning you don't pay taxes on that money until you withdraw it in retirement. This allows your investments to grow tax-deferred, potentially leading to significant savings over time. Roth 401(k)s and Roth IRAs, on the other hand, don't offer an upfront tax deduction, but your withdrawals in retirement are tax-free. This can be especially beneficial if you anticipate being in a higher tax bracket during retirement. Another advantage of tax-advantaged accounts is that you generally don't pay capital gains tax on investments held within these accounts. This allows your investments to grow tax-free, compounding your returns over time. If you're eligible to contribute to a tax-advantaged account, whether through your employer or individually, it's generally a wise financial decision. The tax benefits alone can significantly enhance your savings efforts. Holding assets long-term, a wise strategy. Holding assets for the long term is a strategy that can benefit both your investment returns and your tax liability. As we've discussed, long-term capital gains are taxed at more favorable rates than short-term gains. But beyond the tax advantages, long-term investing allows your investments to ride out market fluctuations and potentially generate more significant returns over time. The stock market, for example, has historically trended upward over the long term, despite experiencing short-term volatility. By holding on to your investments through market ups and downs, you avoid making emotional decisions based on short-term fluctuations. This disciplined approach can lead to greater financial stability and long-term growth. Furthermore, long-term investing aligns with the principles of compound growth, often referred to as the eighth wonder of the world. Compounding allows your earnings to generate even more earnings, creating a snowball effect that can accelerate your wealth-building journey. So, while it's tempting to chase quick profits through short-term trading, remember that patience and a long-term perspective are often the keys to achieving your financial goals. The importance of professional guidance. Navigating the complexities of capital gains tax and investment strategies can be challenging, especially for beginners. Seeking professional guidance from a qualified financial advisor can provide invaluable support and expertise. A financial advisor can help you develop a personalized investment plan that aligns with your financial goals, risk tolerance, and tax situation. They can guide you through different investment options, asset allocation strategies, and tax-efficient approaches. Furthermore, a financial advisor can keep you informed about changes in tax laws or market conditions that may affect your investments. They can provide ongoing support and adjustments to your plan as needed. While some investors may be comfortable managing their finances independently, seeking professional guidance can offer peace of mind and potentially enhance your financial outcomes. A financial advisor acts as your financial partner, working with you to achieve your goals. Remember, investing involves risks, and seeking professional advice can help you mitigate those risks and make more informed decisions. Taking control of your investments. Understanding capital gains tax doesn't have to be daunting. By grasping the basic principles outlined in this guide, you can approach your investments with greater confidence and make informed decisions to potentially reduce your tax liability. Remember, capital gains tax applies only when you sell an asset for a profit. The duration for which you hold the asset determines whether you'll pay short-term or long-term capital gains tax, with long-term gains being taxed at more favorable rates. You can employ various strategies to manage your capital gains tax, such as holding assets long-term, investing in tax-advantaged accounts, and considering tax loss harvesting. Seeking professional guidance from a financial advisor can provide valuable support and expertise. By taking control of your investments and understanding the tax implications, you empower yourself to make smarter financial decisions that align with your goals. Remember, knowledge is power, especially when it comes to your financial well-being. Like, share, and comment for more videos like this.